Well, the corporate regulator says private credit funds are masking defaults and bad loans. A review by ASIC found fee gouging and poor risk management at private credit firms. ASIC saying fewer than half of the funds had detailed written credit or impairment and loan default management policies in place. Just 4 out of 28 funds published information about interest rates charged to borrowers, with interest rates ranging from 2.5% to nearly 42%. ASIC is concerned about transparency in the sector, with more than $200 billion invested in private credit funds. Let's get more on this with Andrew Wilson from Pitcher Partners, who joins me now. Andrew, what do you make of this ASIC news?
I mean, it's not overly surprising when you look across the landscape and the providers of some of these private credit funds. Some of them. There are some very experienced managers, some that have been around for a long time, some that have good governance practices, valuation methodology. They're quite transparent. I'll show you what's in their books, and others that don't. There are some very small funds out there, some managers with less experience who've been doing it for shorter time frames with quite small teams. So it doesn't come as a huge surprise to me that there are some funds out there that aren't meeting ASIC's requirements.
And how would you be responding at Pitcher Partners?
There's not a lot of change for us. The reality is we only use a very small number of private credit managers that where we are comfortable with their people, their processes, where they're outsourcing to other reputable firms to help with loan valuation, to help review the governance processes. So I don't foresee that there'd be a great deal of change for us at Pitcher Partners, but it's definitely something that we're keeping an eye on, and we think it is a good thing for the private credit sector to be having this review.
Let's talk more broadly as well what's happened with superannuation and the changes for Division 296. It's something we spoke about months ago on this show. I imagine that you in the financial advisory world welcome these changes.
Yes, well, I think the changes mean it's a lot better, a better chance of this proposal being legislated. I think you look at some of what the industry viewed as shortcomings of the previous proposal, which is the tax on unrealised capital gains and the lack of indexation of the cap. That's quite inconsistent with other tax legislation and the way other entities are taxed. So changing that to taxation on realised gains, I think, is a lot more sensible to most people. Though when I was reading about this, I couldn't quite find a clear definition of what realised earnings was. So the devil might actually be in the detail there around how the tax applies and how things like franking credits and unused realised losses from previous periods, how they flow into the tax that actually gets applied to the self-managed super fund.
Well, let's talk more broadly about how you, as well as a private wealth advisor, are viewing the overall macroeconomic backdrop, given as well we just had the RBA leaving rates on hold.
Yeah. So look, domestically, we've still got economic growth. We've got a moderate level of growth. We've got low unemployment. Wages are growing. Inflation has come down a lot over the recent period. Yes, it has ticked up a bit in the very recent period. And it sits at the upper end of the RBA's target range. With the Reserve Bank coming out yesterday and saying that rates are on hold, they're taking very much a wait and see approach. I think from an advisor's point of view, when we look at investment strategies, we want to make sure that they don't need to be supported by an environment of declining interest rates over the long term, because we just don't see that that's what's going to happen.
So how are you sort of telling clients to position at the moment?
We still think that investors can generate good returns in this environment, though we are cognizant of the risks, particularly potential for a weakening economic backdrop, valuations where they are in listed markets. But overall, our advice to our clients is you don't want to be positioning your portfolio for a particular set of macroeconomic circumstances. You don't want to be trying to predict, is there going to be a recession tomorrow or isn't there? Are rates on hold, going down, going up? You really want to have a range of good quality assets that can weather all storms, so to speak, and you just need to tolerate that within that there will be some winners, there will be some losers, but at a portfolio level you can generate a good return irrespective of what economic events unfold.
And when you touch on valuations there, when prices do look stretched or expensive, how do you sort of navigate that when you're talking to clients?
So the price that you pay for an investment, it really needs to reflect the current earnings or the current yield, the expected growth, and I guess the risk in that asset. So we very much look at it through that lens. We also we'll look at one asset class relative to another. So we might look at the earnings yield, let's say, on the ASX 200 relative to the yield on Australian corporate bonds. If investors did that exercise and look over a period of time, you'll see, the spread between the two, that return premium has really narrowed. So what it indicates to us is that, perhaps when you're investing at a market level, you're not going to be receiving the same return premium in equities that you had in the past, and now's the time to be a bit more selective around the underlying assets that you're invested in.
And what about fixed income? Particularly, we touched on the RBA then, and if there is only one more rate cut in the cycle or potentially none, how do you approach the fixed income market?
In our opinion, fixed interest still has an important role to play in portfolios. So we hold a mix of your longer duration fixed income assets and shorter duration and floating rate fixed income assets. When we look at Australian government bonds, we're still seeing yields that, relative to the last 10 to 15 years, are at reasonably high levels, and they can act as a true defensive position in portfolios. Corporate bonds, spreads have tightened a bit, so now we're leaning a little bit more towards active management over passive strategies, because your active managers are going to have more tools at their disposal to navigate the environment that we're in at the moment. And of course, private credit, like we touched on, and there we're looking, we want senior secured positions, we want big diversified pools of direct loans and asset-backed securities, as we believe that's how you can protect yourself whilst also benefiting from the increased yield that you get in private credit markets.
And just quickly, away from domestic opportunities, where else are you looking?
So global share markets have the same issues to an extent of the Australian share market, which is stretched valuations. If we look at over in the US, that's really been driven by the magnificent 7 companies. And look, some of those we are still comfortable having in portfolios and having our clients invested in, like Google's, Microsoft, Nvidia. Their forecast earning growth seems to justify holding those positions in portfolios, but we want to make sure we've got a degree of diversification around that, so outside those big stocks into companies like, perhaps ING. We looked at Eli Lilly, Visa's a great business, and then outside of that into your non-traditional asset classes, so that can be unlisted infrastructure where you've got exposure to defensive earnings, private equity where valuations aren't quite as volatile, and there's a whole range of uncorrelated assets like you've got royalties, litigation finance, catastrophe bonds. Those types of things can really diversify away from your traditional equity and bond portfolio.